It's a Monday morning. Sarah is sitting at her kitchen table, coffee in hand, scrolling through her phone before work. Then, she sees a notification from her bank. Overdraft fee charged $35. Her stomach drops. Confused, she opens her banking app. Last Friday, Sarah transferred her final $5 from checking into savings. She thought she was being responsible. What she didn't realize was that her $15 gym membership was scheduled to autodraft over the weekend. Instead of declining the charge, instead of sending a warning, instead of charging a small fee, her bank hit her with a $35 overdraft fee for being $10 short. But that wasn't the end of it. As Sarah scrolls through her account, she notices other charges she had barely paid attention to. A $12 monthly maintenance fee because her balance dipped below $1,500. A $3 out-of-network ATM fee. A $25 paper statement fee she forgot to turn off. A $95 annual credit card fee. When she adds it all up, Sarah realizes something shocking. She's paid nearly $400 in bank fees in just 6 months. Money that could have gone toward her emergency fund. Money that could have paid down student loans. Money that simply disappeared. And Sarah is not alone. The bigger problem: millions of Americans face situations just like this every single year. According to data from the Consumer Financial Protection Bureau, Americans paid approximately $12.60 billion in overdraft and non-sufficient funds fees in 2024 alone. At the same time, the 6 largest U.S. banks reported combined profits of over $150 billion that same year. Let that sink in. While everyday people struggle with surprise fees and shrinking balances, big banks continue posting record-breaking profits. This isn't an accident. It's a system. Why people are fed up with big banks. The frustration goes far deeper than annoying fees. Over the past few decades, trust in major financial institutions has been steadily eroded. Think back to 2008. Big banks packaged risky subprime mortgages into complex financial products and sold them as safe investments. When the housing market collapsed, millions of Americans lost their homes, their jobs, their life savings. The economy nearly collapsed. And what happened to the banks responsible? They were bailed out with taxpayer money. Bank of America alone received $45 billion through government bailout programs. And in the years immediately following, major banks paid tens of billions of dollars in executive bonuses. The message was clear. Losses were socialized. Profits stayed private. More scandals. Same pattern. Then came the Wells Fargo scandal. Employees secretly opened millions of unauthorized accounts just to meet aggressive sales quotas. Customers were charged fees for accounts they never asked for. Over 500,000 people were charged for auto insurance they didn't authorize, leading to wrongful car repossessions. Credit scores were destroyed, lives were disrupted, and trust completely shattered. According to a Gallup poll in late 2024, only 26% of Americans say they have high confidence in banks. That's one of the lowest trust levels in decades. So, what are your options? You still need a place to keep your money. You still need to pay bills, get paid, and borrow when necessary. The good news: big banks are not your only option. Option 1. Community banks. Community banks are smaller, locally owned institutions that serve specific regions. When you deposit money at a community bank, it usually stays in your community funding. Small businesses, local mortgages, neighborhood development. Instead of navigating endless phone menus, you can often walk into a branch and speak to someone who actually knows your name. Fees tend to be lower. Service tends to be more personal, and your money is still FDIC insured, up to $250,000. Option 2. Online banks. Online-only banks have exploded in popularity. Why? Because without physical branches, they save massive overhead and pass those savings to customers. Most online banks offer no monthly maintenance fees, no minimum balance requirements, higher savings, interest rates, ATM fee. In 2024, traditional banks paid around 0.4% APY on savings. Many online banks paid 4.5% to 5%. That's the difference between earning $40 versus $500 a year on the same $10,000. The trade-off: no physical branches and cash deposits can be less convenient. Option 3. Credit unions, the game changer. Credit unions operate on an entirely different philosophy. Banks are for-profit corporations owned by shareholders. Credit unions are non-profit cooperatives owned by members. When you join a credit union, you become a partial owner. That means lower fees, better loan rates, higher savings, returns, member-first decision-making. In 2024, average car loan rates were lower at credit unions. Credit card APRs were often half of big bank rates. Many credit unions eliminated overdraft fees entirely, and your money is just as safe insured by the U.S. government. Are credit unions perfect? No. Some have simpler apps. International banking can be limited. Loan sizes may be smaller, but for everyday Americans, they often provide better value, better service, and better alignment with customer interests. Making the switch. Switching banks isn't complicated. It just requires planning, research, insured institutions. Open a new account. Run both accounts in parallel. Move direct deposits and bills. Close the old account carefully. There's a strange irony in big bank advertising. They market themselves as local, friendly, a community, but they're massive corporations optimized for profit. If banks tell you that small, local, and relationship-driven is better, maybe you should believe them, just not them. Sarah did. She switched to a credit union. No monthly fees, higher savings interest, no overdraft penalties. That $400 she used to lose every year, now it goes toward her future. Your money, your choice, your future. Big banks aren't your only option, and for many Americans, they're not the best one either.